Aloha. Policy design for infinite banking and the tax-free cash growth warehouse strategy is critical to the performance of the account. When properly designed, the account will offer several options for customization after the policy is issued. Obviously, customization is key in the beginning, but you may want to change things up later on, even much later on in the life of your account. In this video, I will explain the options that are available after the account is established and the policy is delivered. The most often desired customization option is to increase the cash value growth. There are a few options to make that happen after issue. In another video on this channel, I explain the three most common methods for adding to the cash value and their restrictions. They are: 1, unscheduled paid up additions, which adds to the face value benefit as well as the cash value. 2, prepaying the term portion of the design of your policy, which adds to the cash value and may lower the total premium going forward, or may simply reduce the number of years that the term portion will remain as a part of the total face value benefit. And 3, paying a 10% additional to the scheduled paid up additions rider. There's another option to increase the cash value, and this is an ongoing kind of an option. That is to add to the scheduled paid up additions. So if you have a $100 per month scheduled paid up additions rider and you want to increase that, you may apply to do so. It will most likely require a new paramedical exam to prove insurability, the same as adding unscheduled paid up additions, but it is a possible option, and it will then become part of the ongoing scheduled premium. Now, with regards to scheduled riders, such as scheduled paid up additions and scheduled term rider, those may be reduced or even eliminated. Some years after the policy has been in force, you may want to reduce your required premium payments by reducing or eliminating either or both of those riders. The premium will be reduced accordingly. You need to be aware that in the case of reducing or eliminating the term rider, the face value benefit will also be reduced correspondingly, because the term rider makes up a portion of the total face value benefit of the policy. If you choose to reduce or eliminate the paid up additions rider, the face value will not be reduced. It will just grow a little slower than with the rider being unchanged. The required premium will be reduced, but the cash value and face value will continue to grow, just not as much as with those riders fully intact. Usually in years 3, 5, and 7, you will be offered the option to increase the total face value of your policy by buying additional whole life insurance up to the current amount of whole life of your policy. For example, if you currently have $200,000 of whole life as part of the design of your total policy, you may be offered the option of buying an additional $200,000 or up to $200,000 of whole life added onto the policy. Now, that will increase the total premium required on the policy, but it will not cause the policy to mech, as it likely would if you were to just add an unscheduled paid up additions that would accomplish the same thing, but without increasing the ongoing premium. Now, let's say you just don't want to pay any premiums any longer for whatever reason. Maybe you're retired and are done investing and done using the tax-free cash growth warehouse strategy. Maybe you want to start using the account as a supplemental tax-free retirement income. To eliminate the premium completely and still keep the policy, you can execute a reduced paid up option, what we refer to as an RPU, reduced paid up. How that works is the total amount of whole life insurance that has been paid fully for by the premiums that you've paid up to that point will remain. But the total face value will now be reduced to what that amount is only. For example, if you started out with a $1 million total benefit policy, that is with a combination of whole life and term rider, and you've paid the premiums for 15 years of what was scheduled to be paid for 40 years, your policy face value has probably grown to about maybe $1.4 million or so by now. But now you want to stop the premiums, and at that point, you've fully paid for $600,000 of whole life. Now, with the RPU, your policy face value will be reduced to the $600,000 amount of whole life that you have fully paid for, and you will no longer have any premiums due. Reduced paid up. These figures are just guesstimates and will vary depending on your particular policy, your age, and how much you've actually paid in, but this is a fair estimate. The really cool thing is that your policy will still not only be in force, but it will continue to grow in both face value and cash value because it will continue to earn that beautiful compounding dividend interest. So there are options to add to the cash value, increase the cash value growth, or decrease or even eliminate the premiums altogether. We hope that you found this information helpful. Please post your questions and comments here, and please subscribe to this channel. You have questions about infinite banking and the tax-free cash growth warehouse? We have answers. And if you haven't yet, watch our free webinar, How to Become Master of Your Financial World. Just click on the link in the description box below here. We look forward to helping you. Aloha and mahalo for watching.